November 30th, 2023. A lot of times late in the month, you'll get, or on the last day of the month, today is the last day of the month, you'll get, big vacuum tests, etc. And it has to do with the monthly chart, really. It's traders trying to affect the appearance of the monthly chart. And that was what was happening at the end of the day here, where bulls were trying to get as good of a close as possible. I also actually thought it had a little bit to do with the daily chart as well. Um, if you look, this was the sell yesterday, right? The sell signal bar was this, and it's potentially a couple legs up. We should get two legs sideways to down here. Um, but I generally thought traders who sold below this day were going to be disappointed in the follow through that they got. And, this is exactly that. This is disappointing follow through. And so that was one of the reasons why at the end of the day, when we started to sell off, I was kind of concerned that it wasn't going to go all that far because of the daily chart. I thought that the traders who took the sell below yesterday's low were going to end up disappointed and getting a disappointing close. And we started to get this sell off, and it seemed low probability that we were just going to get a big crash, and these traders would in fact not be disappointed. So I didn't think we were going to get this, but during this rally, I thought the target was the open of the day so that the bulls could get a bull close and disappoint the traders over here. But yeah, bar one, a bear bar with big tails on either side, so more of a trading range bar than anything else. Bar two is follow through for the bears, but we're basically right on support. You know that we're probably going to test below yesterday's low, but you also probably don't think we're going to get all that far below yesterday's low because again, the daily chart shows that the traders who are going to take the sell below this low are probably going to be disappointed. And so that's why you get bad follow through on bar three. We got to the low, we bounced. And then same thing with four, we rejected again off that low because again, there shouldn't be that many sellers below that price. And a lot of times, when you're testing a prior day's low, it's gonna find some sort of support. It's pretty rare that you're just gonna sell straight through it. And if you do sell straight through it, you're probably gonna try and come back and test it because the market tends to oscillate around magnets. Big bull bar on five, but these two legs down were pretty steep, so we're probably in a trading range. And so, five also is a pretty disappointing close, and it might just be a vacuum test of this close yesterday, which was a reasonable buy the close bar. So I think five is more just a vacuum test, and this is a tight enough channel; it should get a second leg down, and we're probably in a trading range. So if you're buying here, you're buying high in a trading range. For all those reasons, you get a disappointing close on bar six. When you get the disappointing close on six, any bulls who were long, who were maybe about to close at five, just taking a chance, we're just going to get a bar like 18 and go straight up. Obviously disappointed in six, and they sell out of their longs, causing seven. Seven, a big bear bar, closing yards low, but one pullback, two pullback, three. So this is a third push down at the bottom of what's probably a trading range, and you're selling right where bulls bought a couple times, right? Right at yesterday's low. So I don't think that taking any sort of short on the close or below seven is very smart. Again, especially with the big up on bar five, it just seems like big up, big down, and that usually leads to sideways trading. Bar eight, it's a bull bar, but a big tail on the top. It's an inside bar. So, if you get another inside bar on nine and you get an II pattern, that would be a reasonable swing buy after the wedge. But chances are you're not going to get it because we're in a trading range, and sure enough, you get nine. And I think there's a lot of problems with nine. One being you're testing right here. So anyone who, the top of this climax is technically a reasonable sell by the close bar. It's not good, but some traders will do it. And so that you're going to find sellers up there for those traders. Additionally, we went up on eight, down on nine, or down on eight, and then down on nine, and then back up. So it could be a two-legged correction, right? Think about it. Up on eight, down on nine, up on nine. So that's two legs up. And if you have two legs up towards the top of a trading range, you typically don't want to be buying. My other problem with buying nine was there was a tail on the top of the bar. I thought if this was going to be, some sort of rally from the open, that we were probably going to get a pretty much perfect close on the close of bar nine. And we really didn't end up getting it. And so I think a lot of traders would be disappointed and not really looking to enter here. And that's why you get a disappointing follow through bar on 10. Even if nine had closed on its high, I probably still would have waited. You're at the top of a trading range. It's always in long, but you are at the top of a trading range. So if you're going to buy up here, you probably need to buy small and look to add on as we get more bull closes. It's really early in the day, so if you're looking to catch that opening swing, it's probably going to go pretty far, right? If you're going to get a bull trend, if you're buying above nine, your premise is it's the opening swing, and we're going to get a big bull trend. And if that's going to be the case, you're going to have a lot of bars to enter. So it's not really all that necessary to enter above 9. Or you could enter a small position above 9 and just look to add on all the bull closes. If you're going to get a big trend, there's going to be good bull closes. You're not going to get a 60 bar micro channel. You could, I guess, but you're not going to get generally just from something like this, and it's just going to drift up with like small bars like this that are really hard to buy the closes. Sometimes, there are examples of small pullback bull trends that'll do that, but there's going to be a lot of other ways to enter than buying the top of the trading range if it's going to be a trend, is my point. Bad follow through on 10, bad follow through on 11. It's a micro double top, 10 and 11. A potential swing sell below 11, but you're selling right on a flat moving average. Doesn't really seem to make a lot of sense. Additionally, something to keep in mind is the context wasn't all that bearish, right? You know that after a bear trend day, which this definitely qualifies, there's a 75% chance of 2 hours of sideways to up trading. So it doesn't really make a lot of sense to be looking to take aggressive swings short. You don't really want to do that. If anything, you want to be taking aggressive swings long. Betting that rather than 2 hours of sideways trading, it'll be 2 hours of up trading. And usually it's 2 hours of sideways to up starting by the end of the second hour is what I meant to say. And you can see, this was basically 2 hours of sideways trading, but even this was a couple hours of sideways trading. Bar 12 followed through for the bears, but I think bears need another bar to make the market clearly always in short. And with how strong this is, I don't think they're going to get it. And sure enough, they don't get it on 13. They get a bull bar closing near its high. And because 13 is so strong, that's why I have a lot of problems with selling below 14. There's a tail on the bottom of 14, and you're selling the bottom of a trading range, so it's not a good sell anyways. But it's better if you don't have a big bull bar right before it, because that means that there were bulls who bought below 13. And since this is probably a trading range, the bulls who bought below 13 are probably going to be able to get out of break even. So you're probably going to have to, you're going to face a pretty deep pullback if you're selling below 14. And 15 could be that pullback. But then, how much lower do you really think we're going to go? Kind of, what's your goal if you're selling here? Do you think we're just going to collapse down? It's pretty unlikely that that's going to happen. And if we are going to collapse down, same thing over here, what I was saying over here. If we're going to collapse, you're going to get lots of strong bear bars closing near their lows. So it's better to wait to sell. You don't need to get in here or the close of, any of these bars. It's better to just wait and see what you get. And what you end up getting is, 16 low one triggers below 15, but you're selling the low one at the bottom of a trading range. Not very smart. 17, it's a tight trading range, 15, 16, 17. I think you can probably buy above 17. It's, 3 pushes down, 1, pull back, 2, pull back, 3. So I think it's probably a reasonable swing buy above 17, but there's a big tail on the top. It's the top of a tight trading range. I am not confident enough in myself to take that trade. I'm sure there are better traders, though, who bought above 17. 18, a big bull bar closing, basically on its high. It could be 1 pullback 2, so it could be a second leg trap. You're buying kind of high in a trading range. But generally, I think buying above 18 is okay because, there's 18, first off, is a common bar for swings. You commonly get, swings on bar 18. I also thought we might test back into the middle of this tight trading range from yesterday, which ended up being the magnet. You can see that's where we ended up going, back into the middle of the tight trading range. But I thought we might get there. And you basically get 2 to 1, risk of bar 18, if I remember correctly. Yeah, right into the middle of the tight trading range. So you're basically getting 2 to 1 buying above 18. So I thought it was a reasonable buy, but you're still buying in the middle of a trading range, so you need fast follow through. Additionally, there's the swing of 40% of an average day's range, 90% of the time in the opening range. Very clear way to say that. 90% of days have a swing of 40% of an average day's range. So the average range over the past bunch of days, it's about 30, 33, 34 points. I checked or generally track the past 15 days daily range and opening ranges, but it's about 34, 30. We'll call it 35 points. 40% of 35. I'm not that good at mental math. 15 points. So you're probably going to get about a 15-point swing, and it's better than 2 to 1. So you'll probably get about a 15-point swing at some point today. So I thought that buying of 18 was okay, but disappointing follow through on 19. So when you get 19, I think a lot of traders are going to want to get out pretty close to break even if they can. And that's why as 20 starts to trade up, the traders are just exiting around the close of 20. 21, another reversal bar, but not quite able to close on its high. I think if it closes on its high, the always in bulls who got out. If it closes on its high and was an outside bar, a lot of the bulls who got out would get back in above 21. But it doesn't close as an outside bar, and it doesn't close on its high. Therefore, I think a lot of traders would rather wait. You get a strong bear bar closing very near its low on 22. And, can you sell 22? Probably. it's probably an okay swing trade, but you're probably not going to get fast follow through. It's going to be, if you're selling that, you probably can't exit above 23 because you took a difficult trade to hold through. So you knew you were probably going to get bad follow through. So you took a difficult trade to hold. So you probably just have to keep holding if you're gonna take the swing below 22. It's a double top, and you had a lot of traders exiting. And if you're an always in bull, even the most stubborn always in bull is probably getting out below 22. So I think it's an okay swing short, but it's really not all that great at all. I wouldn't recommend taking it. Bad follow through on 23 as expected, and then 24 tests back into the tight trading range and then comes back down. Traders who sold below 22 have a chance to get out of break even on 24, but I just don't think that's all a great thing to do. I mean, really all you're doing is you had a bunch of true risk and you're getting out of break even. So I don't think it's really a great idea. If you took the swing below 22, you probably just kind of have to keep sitting. I could be wrong, but I didn't take the trade below 22. So I don't really know. And you get follow through on 25, 26, 27. It's a bear channel. It's a tight channel. We did break out of the 18 bar range on 27. Is it okay to be short? Yeah, probably. But is this where you want to put your money in? Is kind of a question you should ask yourself. There are going to be days that are just difficult to trade, especially early, that are like this, where you're going to end up, if you look back on these days at the end of the week, more so, if you think, a lot of times I found that I would be thinking to myself, if I had just not traded in this, pretty much garbage, there were easy trades. Like yesterday was a relatively easy day for always in swing trading. And today was a really difficult day, or at least the beginning of the day was. And so, I just kind of try to ask myself, is this relatively easy always in swing trading? No. Do I need to be in this market? Really? No, I don't need to be in this. How far is this really going to go? The downside's probably extremely limited. So, just try to ask yourself, is this one of the better trades of the week? Is this really where I want to put my money in? Yesterday when you get a big bear bar and a follow through bar, then you're like, okay, great. I'll put my money in here. You get, a wedge pullback from that and hoping for a second leg down. Great. I'll sell below that all day. I'll sell below that. Great. Good job. But do you really want to be taking this trade where there's so many tails and it's so sideways? And look at all the strong bull closes you have, right? This is going to be a magnet. The middle of this trading range is going to be a magnet. So do you really want to be selling basically what is probably the bottom of a trading range just because it's, in theory reasonable to do? No, I don't think it's all that good of an idea. Bad follow through on 28. I think a lot of traders might end up exiting above 28, which is kind of part of the problem here. 4 straight bear bars, we probably got to get out. Doji bar on 29. Bad follow through for the traders who bought above 28. It's really not a good buy above 28 after this move down. It could be 1, pullback 2, pullback 3. So 3 pushes down to the bottom of the trading range. More problems with this spike. And then a second leg down on 30 from this. But, it's breaking to a new low below 28. But that the bulls who buy below 28 are probably going to make money because limit order bulls have been making money all day. 31 is a big bull bar, but you have essentially a double bottom with 28. And I thought if it closed above the neckline of the double bottom, which was 29, so if it closed above this and maybe slightly above the moving average, it was probably a reasonable swing buy. But, this whole move down is pretty tight. So I thought we needed to go more sideways first for maybe 15 or 20 bars. And, sure enough, you get a disappointing close though on 31, reminding you that you're still in a trading range. And we're at the moving average, in a trading range, but it's also, a trending trading range. It's a bear channel still. It's a broad bear channel, but it's still a bear channel. And in broad channels, you want to sell the top by the bottom. So a lot of traders, when you get bad follow through, are going to be exiting, and some bears might even be shorting. So I thought it was really disappointing that 31 didn't close above the neckline of the double top, and that's one of the reasons we got bad follow through on 32. 33, a bear bar, but big tail on the bottom. Not really, I wouldn't sell below it. Follow through on 34 and 35, and it looks good, but I think that you're selling the bottom of a bear channel and that's not a very good idea. You're probably going to get bad follow through. So I don't like the sell down here because you're selling the bottom of a bear channel. And these bars aren't consistent sizes, right? You want to see, relatively consistently sized bars. Even these bars are, the same size. They get smaller and then again bigger, but you can understand what I'm saying, right? You want to see relatively consistent trading, and these have big tails and the trading is not all that consistent. So I don't think, and just the overall context is not very good for a swing down. We were kind of primed for a swing down this day, but remember what I was saying earlier. I thought the bears who sold below this day were going to end up disappointed. And since I thought they're going to be disappointed, I didn't really want to. I was really hesitant to sell in any of this. And with all these good bull bars early in the day, it made me think even more that we're probably not going to go all that far. It's another reason why you get bad follow through on 36 and 37. An inside bar on 38, it's a micro double bottom with 30, 36. Probably going to get pulled back towards the top of the channel. But I think, not good to sell, but I probably wouldn't buy in here either. I'd just wait. And you get a big bull bar on 39. Is 39 a reasonable buy? Maybe if you can scale in, but I think if you're buying above 39, you have to add on below 37 if we trade down there. I think it's a mistake to buy above here and just let yourself get stopped out down here because this is probably a trading range. So you know that if you're able to add on more here, you're probably going to be able to get out. Additionally, if you buy above 39 and you get 40, a lot of traders are just going to get out because it doesn't make sense to hold because it could be a really deep pullback and they just rather buy lower in general. So if you buy above 39 and you get 40, you probably just have to get out during 41. What I saw this as was a trend line break. And when you get a trend line break, in what's probably going to, I thought today was going to be a midday reversal. So I'll start with that. I thought we were going to get a midday reversal today because of how strong the bull price action was. I did not think we were going to go down all day. And since we probably aren't going to go down all day, are we going to go up, are we going to just go race up the rest of the day? Probably not. So what's most likely then? A trading range day. And in trading range days, when you get a drift down like this, just think about it logically, you're probably going to get pulled back up towards the top because it is a trading range. And so, the middle of the day is going to be a magnet and it's going to go up and down and up and down. It's probably not going to just drift down all day because trading range days don't generally do that. Those are bear days. And I thought with the context of the day, a bear day was unlikely. So I thought 39 was a trend line break. And when you get a trend line break and you're expecting to move up, a lot of times you get some sort of major trend reversal set up. And we ended up getting a lower low major trend reversal on 49. It trapped out all the traders. Like I said, if you bought above 39 with, a skunk stop, essentially, you got stopped out and then it starts to go your direction, forcing traders to buy again. But a lot of times when you get a trend line break and then a lower low major trend reversal, you need to get a higher low before you continue up. Same thing how if you get a higher high major trend reversal, you need to get a lower high before you continue up versus if we had gotten, a higher low major trend reversal. So let's say, this was an inside bull bar or something. It's potentially a higher low major trend reversal and you might not need to get that, higher low. You might just reverse directly up from there. So I was talking about the micro double top, 41 or 40-41. Is it an okay sell below 41? Maybe, but you're selling on the moving average at the top of a bear channel, so it's maybe fine. Also, after the trend line break, you might need to get some sort of test down. You don't know what it's going to look like, but it's probably an okay sell. Doji follow through on 42, so tight trading range. Inside bar on 43, maybe an okay swing, and good follow through for the bears on 44. But you're testing the bottom of a buy climax. So I don't think this is really. There's probably not much left to this move, and if there is a lot left to the move, then you'd be looking for something more like this, a breakout below, a couple of strong bear bars, and hopefully some sort of measured move down. But if you're going to get that, you're going to have plenty of time to get in. So I don't think 44 is a good sell. I think you want to see another strong bear bar, 45, closing near its low and below the low of the day, breaking below the wedge, essentially a wedge setup. You can say this whole thing is 1, pullback 2, pullback 3, if you think about it. And usually when you get a wedge and then you get a correction of a wedge, so let's say this whole wedge was, 128 bars. Usually the correction of the wedge is about half the amount of bars. So 28 bars so far. So theoretically, the correction should be about 60 to 65 bars from bar 54. So 45 inside bar, disappointing for the bears. 46, disappointing for the bulls. They wanted to see a strong close, and then another, disappointing bar on 47, 3 tails on top. It's a parabolic wedge, or it's probably not a parabolic wedge, but it's a wedge on a lower time frame, up, down, up, down, up, down. So 3 pushes up, and 48 is the reversal down for the bears. And we're just basically testing back to the bottom of this range, the bottom of the buy climax, not all that good. It is notable that 48 is a strong bar, and if bears can get follow through, maybe we're getting a breakout down. So you can see we try to get the breakout down, but we get a big rejection off that bottom on 49 and a reversal up. But 49 is not able to close on its high. I was really disappointed. I was willing to buy above 49. I knew we were probably going to have to go a little sideways first since it was, a lower low major trend reversal. But I was disappointed with the close on 49, so I waited. And you get bad follow through 50, and no surprise, bear bar 51. I think if you bought above here, you probably just got kind of got to sit through this. Bad follow through 52, 53, and then a good bull bar closing on a tie on 54. I think 54 is what you're waiting for. The problem with it is, you had 3 straight bear bars, which isn't great, and we might have to test back to this high. You're kind of in a tight trading range, but I think it's a good buy about 54 for a swing up. Follow through on 55, 56, 57. Good bull bars. Tails on the tops of these, so not as great as it could be. And then 58, I thought it was interesting. If you bought above 54 to make 5 points, you need the market to get to 45, 56 and a half. And this got, 2 ticks past that, 45, 57, and then it formed a tail. So I thought bulls were scalping out with 5 points. And if some bulls are scalping out with 5 points, it probably makes sense, to get out and look to buy above another bull bar. So you could have gotten out, with 5 points and then waited to see if we get a bear bar. Because sometimes you will get a big bear bar. After a bar like 58, you'll just kind of get bulls will be disappointed and they'll start exiting, causing a bear bar. And then you end up getting out down here rather than up here, and you lose most of your profit. But it traded below 58 and ended up finding buyers on 59. Disappointing follow through on 60. Some traders might exit below 60, but if you do, you just buy again above 61, the outside up bar, or you could buy as the market goes outside up on 60. During 61, above 60. Follow through on 62, and then a couple of good bull bars, 63, 64. At this point, when we started to do this, I thought that we were trying to get to the open of the day. And I thought that if we were going to get to the open of the day, we were probably going to go straight there because, it gets more likely as we get closer that we're going to get to the open of the day, obviously, right? And so if it's getting more and more likely, the bars should be getting, bigger and stronger, and it should be going there faster. I kind of wanted a vacuum test. I thought 64 was fine, but I wanted it to be a little bigger. And then we got a pause on 65. And so that wasn't great, but I still thought that sometimes on 66, you get a big bull bar and then you get vacuumed right up. But it just wasn't the case. We got a disappointing close on 66. When we got that, traders started scalping out. If it's so likely that we're going here, why are we getting bad follow through? So it made me think my premise wasn't valid. And I was long in here, and I just got out below 66 because why are we trading below another bar, right? My premise was we were going to get here really quickly. At this point, if you're still long at this point, your premise is we're going to get a vacuum test at the open of the day. In my opinion, that's what your premise is. Or that's at least what my premise was. And once we started to trade down below 66, well, we're not getting a vacuum test at the open of the day. If we were, there's no reason for the market to be trading below a prior bar. Hindsight, maybe I could have gotten out a point below this low. I don't think I need to get out directly below it. Maybe I could have gotten out here, but I did just exit directly below it. And you get a strong bear close on 67. Can you sell 67? I think you can because always in bulls have to exit below it. And it's 1, pullback 2, pullback 3. So it's a parabolic wedge. It's a parabolic wedge on a trading range day. And a lot of times when you get parabolic wedges on trading range days, you can get quick moves. And I noticed that we hadn't tested the 53 high. And since this is probably a trading range day, we might have to get down there. We got pretty close, but didn't get there. You get follow through on 68 and then a doji bar on 69. I still think it's valid to sell below 68 during 70 because it's such a strong pair of bars that you should at least get a second leg down. And a lot of times I still think you're going to get this vacuum test. And 69 might trap some traders out. And then as it starts to go, traders are forced to sell lower, and that might drive the market down here. I thought your premise was, if you're selling below 68, when the bar 68 closes, you're looking to sell below 68. Your premise is that we're probably going to get here. And I think that once you get 69, it doesn't really change your premise. But I think if 69 triggers and it trades above 69, then your premise isn't valid anymore. But for that same reason, I thought it was okay to sell below and just put a stop above 69, because if we get up here, you shouldn't, your premise isn't valid if you get up above 69 after selling below 68. You were hoping we were going to get a vacuum test down. Kind of the same thing here. Doesn't make sense for us to trade below here if we should have gotten a vacuum test to here. 70, another doji bar. And again, I was short, so I shorted below here during 70, and I just put my stop above 70 once it closed because we shouldn't trade above another bar. If we're going to get down here, it'll probably be a quick move. And then we got 71. I thought 71 was an interesting bar. I actually thought, there are a couple things. So if we're going to get a vacuum test of this high, this bar should probably be larger. It should probably, once 71 started to sell off, I thought that if we're going to get to this high, it would probably just go right there. And it didn't do that. So then you have to be thinking, okay, well, we have consistently sized bars. So are we going to get a big breakout below there? But if we're going to get a big breakout and it's so bearish, why are there 2 doji bars and why was 69 a bull close? To me, this makes me think that we're actually, it's too likely that 71 is a second leg trap. And I think that's why traders scalp out during 72. 72, it's 2 legs down. I wouldn't buy above 72. Some traders might. It's low in a trading range. And nothing is ever as bad as it looks in a trading range. So, even though it's a doji bar, the context kind of makes sense to buy above it. But I personally would stay flat. And, those traders end up getting follow through. And, that's the thing is the end of the month. So maybe more traders will take it because they know that the big moves can happen. And we obviously get the vacuum test back up into this trading range. Reasonable swing trades today. I thought 54 was probably the best trade on the day. I think maybe 18, but I think for the most part in here, if you're an always in trader, you want to be flat. The market does a lot of these almost flips, but there are just slight problems with 9, and this isn't quite always in short. This probably isn't quite always in long. It's maybe okay, but you need to get out quickly. I did take this, but I just got out pretty much immediately when 19 closed. I just pretty much got out of the market. What's funny is I bought 18, and then during bar 19, I just went to go fill a cup of water, and I just kind of walk around my apartment for a minute or so to stretch out because I know I'm going to sit through the full bar on 19. And I thought we were going to get a bull close. I looked about 2 minutes in, and it was a bull close. And then I came back right as the bar was closing, and I saw this, and I audibly was like, "Oh." And that was my sign. I was like, "Well, that's clearly really disappointing, so I need to get out." And I was going to exit anyways, but I just thought it was funny that I audibly made a noise. So yeah, reasonable to buy here, reasonable to buy the close. Have to get out below here. Bears can sell, and the end of the day was a lot better for software traders than anything else. What about from here? I think this whole thing might get another leg down. If we're looking at I'll pull up a 60-minute chart. This channel is pretty tight, so I do think it's going to get a second leg down, and maybe we're going to test somewhere back down here. But overall, we got disappointing follow through for the Bears as expected, and last day of the month. So monthly chart. Again, after these 3 straight bear bars, I think we're going to get another leg down, and we're probably going to at least test this high. But this is a really strong bull bar that might be strong enough for a second leg as well. So overall, just confusing month, confusing range. And tomorrow's the last day of the week. I would pay a lot of attention to the open of the week tomorrow because bulls are going to try and get a bull close tomorrow, obviously, and get 5 straight bull closes, and bears want to disappoint the bulls and get a bear close. So I'd pay a lot of attention to the open of the week tomorrow and what happens with that. And yeah, that's the day.